Okay. Hello, good day. Our topic for today is trial balance. What is trial balance? So, trial balance is a list of all the general ledger account and is an accounting report showing all the closing balance of the ledger account at a point in time. If you would see, general ledger was highlighted because I want you to remember from our previous video, the one that we do general ledger. It was two, one as general ledger and the other one is ledger versus the account. So we will be using those account in proceeding to this one. It was at a given point of time because remember that our accounting has two kind of period, the calendar and then the fiscal period. Because this will be used for our future in the financial statements. Okay? Next. Why do we need to do trial balance? So previously, trial balance was used to ensure that all entries made into the organization's general ledger are properly balanced. These are during the paper accounting. However, nowadays that there are a lot of accounting software, this error has already been eliminated. However, but this is still used by accountant and auditor to assist in producing the financial statement. For the accountant, this is to determine whether the general ledger account are balanced prior to any proposed adjustments, and that the proposed adjustments are also balanced, and that the account, after producing this adjustment to be produced in the financial statement, are still balanced. For auditor, the trial balance is used to determine the account that need more time, or the one that they need to audit further. Okay? So what are the three types of trial balance? So we have unadjusted trial balance, the adjusted trial balance, and the closing trial balance. So our unadjusted trial balance, in some book, it's also called as the working trial balance. These are listing of general ledger account balances at the end of the reporting period prior to any adjusting entries to be made. So these are usually considered not a final accounts in the, or not the final balances in a certain period. Okay? Next, we have the adjusted trial balance. So from the word itself, it is normally prepared after the adjusting entries. So to correct all the errors in the unadjusted trial balance, we will now go to adjusted trial balance. And then the closing trial balance. The closing trial balance is two kinds. Number one is the pre-closing trial balance. It still consists of both the nominal and the real account. Remember, what's the nominal account? These are accounts in the income statement. Why? Because nominal account are usually written down to zero every end of the accounting period. Whereas the real account, these are balance sheet account. These are called real because these are the account that accumulate over time. Okay? So we also have the post-closing trial balance. And post-closing trial balance are normally list of all the permanent account before a new accounting cycle would be started. But for this lecture, we would be focusing on unadjusted trial balance. See? Remember this one? So these are the accounts that we have used from our previous video. And if you would check that this unadjusted trial balance is listed by assets, liability. So we have assets, liabilities, equity, and then revenue, and then the expenses account. And the expenses account. So if you would also check that this account are listed in according to how it was converted to cash. So because it's usually, financial statements are usually arranged in terms of liquidity. Okay? So if you would see cash, and then AR, because when you will be able to collect AR, it will now be cash. For supplies, you have to sell that, and sometimes it would be cash outright, or sometimes they wouldn't be paying you, so it would go to accounts receivable and so forth. So normally, it's arranged depending on liquidity. Okay? So let's see. Remember this one? This one is taken from our previous video, which is our general ledger. So if you would see that the account is getting the balance in our ledger. So 56 56. And if you will check, it's a positive balance because the normal balance of assets are debit. Okay? Next. So for AR, you would see it's just the same. And so for our supplies, and then for our prepaid rent. See, but why is it different? I put different accounts so that you would realize it's prepaid rent are also advance rent, meaning you pay ahead of time for your lessor. In some books, it's called deposit because you had to consume it in some contract after a certain period. So these are usually can be compared with your prepaid loads. Okay? So you buy the load, you have 300 and then consume it over time. That's the same as your prepaid rent. The balance is still the same. So we have the computer. And then accounts payable. See, why do I make it red? So that you would know that this is zero account. But the zero account usually eliminated to reduce the size of the trial balance. Because in some company, it would be lengthy. Because they have a lot of accounts. Okay. Next, we have the equity. See, equity has a credit balance. So that's why we also put it on a credit. See? Because we say credit balance are for the liabilities, revenue, and equity account. So next, we have our revenue. And then our utilities. And go back to debit. Okay, and then lastly, our withdrawal. Withdrawal is also a nominal account and it is close to equity account at the end of the accounting period. Next. However, if you would see, let's go back. Sorry. You see, it's a balance figure. 275 per debit and 275 per credit. However, sometimes there are still error despite it is balanced. The debit and credit had a balance figure. And the error are normally this one. So what are the errors? So it could be posting the amount in the same journal twice. Or omitting the entire transaction. Making a number errors. Posting a journal to a wrong accounts. But this three, and lastly, is to switch off the balance between credit and debit. We will discuss the switch later. But the first four are usually determined and not determined and corrected in the adjusting entry. And usually this one occur or arises and can be seen during the course of audit. Okay? So the switch, look at this. The switch, so sometimes we would, this is our common problem, we would sometimes forgot which is debit and which is credit. So take note, debit, these are what the company owns, like assets. And then credits are those that the company owe. So these are normally equity and then liabilities. For revenue, it's also credit because revenue are what you accumulate over the business that would normally close to your equity account. And so with the expenses is a debit account because these are the amount that you had accumulated to earn the revenue. And it's also close to your equity account later. See? We mischarge it, but it is still balanced. However, this is wrong because take note, assets and expense has a normal balance of debit and not credit. And liabilities, equity, and revenue has a normal balance of credit and not debit. Okay? Do you have any question? If you like this view or this video, please help me to reach out more people by hitting the subscribe button below. And God bless you all. Just comment below so I could get back for any other questions that you have.